Ever see those charts with lines going up and to the right, making people tons of money in the stock market? It seems so easy, right? But then you try to dip your toes into the world of investing and it feels like everyone is speaking a different language. Don't worry, you're not alone. Want to start investing but feel lost in all the stock market jargon? You're not alone. In this step-by-step guide, I'll show you exactly how to invest in stocks the right way in 2025, even if you have zero experience. We'll break down everything from understanding basic terms to picking the right investments for you. Whether you're just starting out with a few bucks or you're ready to throw down some serious cash, this video will give you the tools and confidence you need to become a successful investor. So buckle up, smash that like button for the YouTube algorithm, and let's dive right in. Before you even think about throwing money into the stock market, you need to understand the basics. First up, we have stocks. Think of a stock like a tiny slice of ownership in a company. When you buy a share of Apple stock, you're basically becoming a part owner of Apple, along with millions of other investors. And just like a business owner can profit when their business does well, you can profit when the value of your stock goes up. But, and this is a big but, just like any business, there's risk involved. Next, we've got ETFs, or exchange-traded funds. These are great for beginners because they let you invest in a whole bunch of stocks at once. Imagine buying a pre-made basket of stocks instead of picking each one individually. That's what an ETF is. Finally, let's talk about dividends. Dividends are like little bonuses that companies give to their shareholders. Not all companies pay dividends, but the ones that do usually distribute them quarterly. Think of it as a little passive income stream from your investments. All right, so you understand the basics of stocks, ETFs, and dividends. Now it's time to figure out where you're actually going to buy and sell these things. This is where brokerages come in. A brokerage is basically your online stock trading platform, kind of like your Amazon for stocks. There are a ton of different brokerages out there, but some are definitely more beginner-friendly than others. If you're in the US, some popular options include Robinhood, Fidelity, and TD Ameritrade. Robinhood is known for its simple interface and zero commission trades, which is great for beginners. Fidelity and TD Ameritrade offer more research tools and resources, which can be helpful as you gain more experience. For those of you in the UK, you might want to check out Trading 212, Hargreaves Lansdown, or Freetrade. And finally, for our European viewers, popular brokerages include eToro, DeGiro, and Interactive Brokers. No matter which brokerage you choose, make sure to do your research and compare fees, features, and ease of use before you commit. Now that you know where to buy stocks, it's time to figure out how you want to invest. Are you the type who likes to buy and sell quickly, trying to time the market and make a quick buck? Or are you more of a long-term investor, content to buy and hold for years, even decades, to build wealth slowly and steadily? The first approach is called active trading. And it's kind of like the stock market equivalent of flipping houses. You're constantly buying and selling, trying to buy low and sell high. It can be exciting, fast-paced, and potentially very profitable, but it also comes with a much higher risk. Active trading requires a lot of time, knowledge, and emotional discipline, and even then, most active traders actually lose money. On the other hand, long-term investing is more like planting a tree and watching it grow. You buy quality companies or ETFs and hold on to them for the long haul, benefiting from their growth and dividend payments over time. It's a much more passive approach, and it's generally considered to be less risky than active trading. Think of legendary investors like Warren Buffett. He didn't get rich by day trading. He got rich by buying great companies and holding on to them for decades. If you're just starting out, I highly recommend taking the long-term approach. It's simpler, less stressful, and historically it's been the most profitable strategy for most investors. You've probably heard the saying, don't put all your eggs in one basket. Well, nowhere is that truer than in the world of investing. Diversification is key to managing risk and maximizing your chances of success. Imagine putting all of your money into a single stock, and then that company goes bankrupt. Yikes, right? That's why it's crucial to spread your investments across different industries, asset classes, and even geographical regions. A well-diversified portfolio might look something like this. You could allocate 50% of your portfolio to ETFs, specifically broad market ETFs like the S&P 500 or Vanguard ETFs. These give you exposure to hundreds of different companies across various sectors, providing a solid foundation for your portfolio. Then, you could put 30% into individual stocks. This is where you can have a little more fun and pick companies that you believe in and that align with your investment goals. Think Apple, Tesla, Microsoft, or any other companies you think have a bright future. Finally, you might consider putting the remaining 20% into bonds or REITs. Bonds are generally less volatile than stocks and can provide some stability to your portfolio, especially during market downturns. REITs, or real estate investment trusts, allow you to invest in real estate without actually having to buy property, offering another layer of diversification. By spreading your investments, you're essentially hedging your bets and reducing the impact of any single investment on your overall portfolio. One of the biggest misconceptions about investing is that you need a ton of money to get started. That couldn't be further from the truth. In fact, you can start investing with as little as $50 per month. The key is to start small, be consistent, and let the power of compound interest work its magic. Compound interest is like the snowball effect of investing. As you earn returns on your investments, those returns get reinvested, and then you earn returns on your returns, and so on. Over time, even small contributions can grow into significant sums of money. One of the best ways to take advantage of compound interest is to use a strategy called dollar cost averaging. This simply means investing a fixed amount of money at regular intervals, regardless of what the market is doing. So, instead of trying to time the market and buy low, sell high, you're consistently investing, whether the market is up, down, or sideways. The beauty of dollar cost averaging is that it takes the emotion out of investing. You're not making impulsive decisions based on market fluctuations. You're sticking to your plan and letting time work in your favor. Remember, investing is a marathon, not a sprint. Stay patient, stay informed, and never stop learning. There you have it. You're now armed with the knowledge and tools to start investing in the stock market. Remember, investing is one of the most powerful ways to build wealth over time, so don't wait another day to get started. If you found this guide helpful, hit the like button and subscribe for more finance tips. I'll be sharing more strategies, tips, and tricks to help you make smarter financial decisions and achieve your financial goals. Now go out there, start investing, and let's build some wealth together.